Okay, let's unpack this Broadcom earnings release. Q2 fiscal 25. And wow, some really big numbers catching attention.
Yeah, definitely making waves. Record revenue, significant growth year over year.
And it seems crystal clear, doesn't it? It's powered by AI, semiconductors, and also their software segment, especially with VMware now folded in.
Absolutely. Feels like a really good moment to look inside, one of the key companies really building the infrastructure for this whole tech boom.
Right. It's more than just reading the numbers. It's about understanding what's underneath the strategy, the market shifts.
Exactly. What does it signal for AI, for enterprise tech going forward?
So for this deep dive, we've got the official press release, the hard numbers, and we've also got the transcript from the earnings call. Hock Tan, Kirsten Spears.
Yeah, leadership commentary. And our mission here really is to cut through that, pull out the key insights. What drove this quarter? What are they signaling for the future?
And importantly, what does it mean for you, the listener, trying to make sense of all this complex information?
Precisely. Let's get those digestible takeaways.
What were the big top-line figures?
Okay, so total revenue hit a record, $15 billion.
$15 billion. Wow.
Yeah, and that's up a strong 20% compared to the same quarter last year.
Okay. And they mentioned that growth is essentially organic now, right? Because Q2 last year already had some VMware in it.
Exactly. That's a good point. So that 20% feels like, real underlying growth year over year.
Okay, real growth there. What about profitability? That was strong too.
Oh, yeah, very strong. Adjusted EBITDA came in at $10 billion.
$10 billion.
Which is up 35% year over year. And that represents 67% of revenue. They actually beat their own guidance, which was 66%.
Okay, nice beat there. And operating income?
That followed suit.
Right.
$9.8 billion, up 37% year over year. Pushes the operating margin to like 65%.
Those are some seriously strong figures. So the takeaway for you listening is these high-level numbers show a company growing fast, yes, but also very efficiently. Expanding margins year over year. That's the big picture.
Right. And where it gets really interesting, I think, is when we break it down by segment, because that's where you see these two sort of growth engines firing.
Okay, let's start with semiconductor solutions then.
All right. So revenue for the semi segment was $8.4 billion in Q2.
Okay.
That's up 17% year over year. And what's notable is this growth rate actually accelerated. It was 11% in Q1, now it's 17%.
Interesting acceleration. And semis were, what, just over half the business this quarter?
Yeah, about 56% of total revenue.
And within that, obviously, AI is the massive piece everyone's watching.
A huge piece. Just the AI semiconductor revenue alone was over $4.4 billion for Q2.
$4.4 billion?
Yeah. And that's up a significant 46% year over year. 46%.
Wow.
And get this, this is the 9th consecutive quarter of sequential growth just in their AI semiconductor business.
9th quarter, that just speaks to sustained, powerful demand, doesn't it?
It really does. It's quite a streak.
So how does that $4.4 billion in AI revenue break down? Is it all one thing?
No, it breaks down. So AI networking was particularly strong. There was 40% of the $4.4 billion in Q2. And that networking piece grew over 70% year over year.
70% growth in AI networking.
Yeah. And then their custom AI accelerators, the ones they call XPUs, specialized chips for specific AI tasks, those also grew double digits year over year.
Got it. And which specific products are driving that huge AI networking number? You said 70% growth?
It's primarily their Ethernet stuff, their Tomahawk switches, their Jericho routers, and their NICs, the network interface cards.
Right.
And there was a big announcement this quarter. The new Tomahawk 6 switch.
Yes, I saw that. That thing sounds like a monster.
It really is, 102.4 terabits per second capacity. Management really emphasized the impact here. This switch lets hyperscalers build these massive AI clusters, potentially over 100,000 accelerators.
100,000?
Using just 2 tiers of switches instead of 3.
Okay, and why does that matter so much? Fewer tiers.
It means less latency. Things communicate faster, you get higher overall bandwidth efficiency across the cluster, and it actually uses less power for the same amount of compute. It just simplifies and supercharges the whole network structure for AI.
Makes sense. Okay, so that's the booming AI side of semiconductors. What about the other part, the non-AI semiconductor business?
Yeah, that's a different story, as you might expect. Non-AI semi-revenue was $4 billion in Q2.
Okay.
Which is actually down 5% year over year.
Down 5%, so still soft there.
Yeah. Management's view seems to be that this segment is, near the bottom of its cycle, and the recovery is proving quite slow.
Were there any bright spots sequentially, maybe comparing to Q1 within non-AI?
Yes, a few. Sequentially, broadband products, enterprise networking, and server storage were all up a bit from Q1.
Okay.
But industrial and wireless revenues were down. Wireless, of course, has its typical seasonal decline this time of year.
Right. And what are they expecting for non-AI in Q3? More of the same.
Pretty much. They expect the non-AI segment to stay relatively flat, around that $4 billion mark, again in Q3.
Got it. So AI semis, tremendous acceleration, strong momentum, non-AI side, stable maybe, but still soft year over year. Okay, let's shift gears. The other major engine, infrastructure software.
Right. And this segment also delivered strong results. Infrastructure software revenue was $6.6 billion,
6.6 billion.
up a robust 25% year over year. And that also exceeded their own guidance for the quarter.
Okay, 25% growth in software. What's the primary driver there? Is it all VMware?
It's largely the VMware integration, yeah.
Yeah.
Specifically, the success they're having converting those big enterprise customers from the old perpetual vSphere licenses
Right, the old model.
to their new VCF subscription model. VCF is VMware Cloud Foundation.
And how's that conversion going? Did they give numbers?
They did. They said they made significant headway. Over 87% of their top 10,000 largest customers have now adopted VCF.
87%. So they're really moving that massive installed base over.
They are. It's a huge effort, but it seems to be working.
What's the impact then on recurring revenue? That's the key, right?
Exactly. And it's generating strong, predictable growth. Their core infrastructure software business is seeing double-digit annual recurring revenue ARR growth.
Double-digit ARR. Okay.
And that's that predictable stream of money coming in each year from the subscriptions. It's a direct benefit flowing from those VCF conversions, really kicking in since the deal closed about, what, a year and a half ago now?
Yeah, about that. So for you, the listener, looking at these segments really highlights the strategy, doesn't it? You've got one engine on the bleeding edge of AI hardware just booming, and a second engine generating reliable, growing revenue by transforming this huge, sticky software base into a subscription machine.
Well put. Two powerful engines. Which naturally brings us to the future outlook. What did management guide for Q3?
Okay, Q3 fiscal 25 guidance, they're forecasting consolidated revenue of approximately $15.8 billion.
15.8. So continued growth?
Yeah, if they hit that, it would be up 21% year over year. Still very strong growth.
And is the AI story still central to that Q3 outlook?
Absolutely. They're forecasting Q3 AI semiconductor revenue specifically to reach $5.1 billion.
5.1 billion.
Which would be a 60% increase year over year. 60%.
Wow. And if they hit that, that would be the 10th consecutive quarter of growth in AI semis.
10th consecutive quarter, exactly. Just incredible momentum carrying forward.
Okay, what about the segment specifics for Q3, semi versus software?
Right. So semiconductor revenue overall is expected to be about $9.1 billion. That's up 25% year over year.
Okay.
And infrastructure software revenue around $6.7 billion, which would be up 16% year over year.
Got it. Now, one detail in the Q3 guidance caught my eye. The expected consolidated gross margin. They said it might dip a bit sequentially.
Yeah, that's right. They anticipate it will decline sequentially by about 130 basis points or 1.3%.
Interesting. Did they say why? Why the expected dip in margin when revenue's still growing strong?
They did. According to management, the main reason is they expect a higher mix of those XPUs, the custom AI accelerators, within their overall AI revenue in Q3.
Ah, the XPU mix.
Yeah, and the CFO clarified that the margins on XPUs are slightly lower than most other products in their portfolio. The only thing lower, apparently, is their wireless business.
Okay, that makes sense. Mix shift impacting overall margins slightly.
Well,
and their adjusted EBITDA outlook for Q3. Still strong.
still very strong, expected to be at least 66%.
Right. Okay, let's maybe take a slightly deeper dive into those AI dynamics. Because management had some really notable comments about the future trajectory beyond just Q3.
Yeah, definitely. How are they seeing that growth rate looking further out, past Q3 into maybe fiscal 2026?
This is where it got really interesting. Management actually stated quite clearly that they anticipate their fiscal 2025 AI semiconductor revenue growth rate, which is running around 60% right now.
Right, 60% this year.
They think that could potentially sustain into fiscal 2026.
Sustain 60% growth on that already huge base.
Yeah.
That's a bold forecast.
It is quite a forecast. Sustaining that level of growth is remarkable.
What gives them that confidence for 2026? Did they elaborate?
They pointed to a couple of things. One, very strong customer visibility. They seem to have a good handle on orders and demand. Two, continued robust demand for both AI training and AI inference workloads. It's not just training anymore.
Ah, inference is picking up steam.
Exactly. And Hawktan also emphasized new product cycles, specifically mentioning that Tomahawk 6 switch again, saying it's seeing tremendous demand.
You mentioned inference becoming more important. How is that influencing their outlook specifically?
Yeah, this seems like a key shift they're watching closely. The hyperscale customers, the big cloud players, they're increasingly focusing on inference. That's using the trained AI models to actually do stuff, answer queries, generate images, run applications.
Right, that's where the monetization happens.
Precisely. They're doubling down on inference because that's how they get a return on the massive investments they've sunk into building the training infrastructure. So management suggested this accelerating focus on inference could potentially boost demand for their XPUs even further, maybe into the latter half of 2026.
Interesting. Okay, we saw AI networking was 40% of their AI revenue in Q2. Do they see that mix between networking and accelerators changing going forward?
Yes, they do. Management expects that the share of AI revenue coming from networking will likely decrease. They projected it to go below 30% in fiscal year 2026.
Below 30%. So does that mean networking is shrinking or just that accelerators are growing even faster?
It's the latter. It's not that networking is shrinking, they expect it to remain very strong, but they anticipate the custom accelerators, the XPUs, will continue to ramp up at an even faster pace, taking a larger slice of that rapidly growing AI pie.
Got it. The pie is growing, but the XPU slice is growing faster than the networking slice.
Exactly.
And within networking, you mentioned scale-up clusters earlier, linking lots of AI chips tightly together. What's happening there?
Right, scale-up is crucial for training really large models.
Yeah.
It's about connecting many powerful processors, like XPUs, to work as one giant supercomputer for a single big task. Scale-out is more distributed.
Okay.
Management noted that the networking within those scale-up clusters, the actual XP to XPU interconnects, is rapidly shifting towards open standard Ethernet.
Moving to Ethernet for that tight coupling.
Yeah, and they highlighted a key technical detail. The density of switches needed in scale-up is much, much higher, potentially 5 to 10 times more switches per accelerator compared to a typical scale-out deployment.
5 to 10 times more switches per chip. Wow, that's a lot more networking gear.
It is. It implies significant demand for high-performance Ethernet switches specifically designed for these dense AI fabrics.
Okay, so more Ethernet switches needed for these powerful integrated systems. What about the future of those connections? Especially when you need to link chips over slightly longer distances within the rack or across racks. I know there's talk about optics.
Exactly. That's the next frontier. As these scale-up clusters get truly massive, maybe linking beyond, say, 72 or 128 chips together, the physical distance limitations of traditional copper wiring start becoming a real performance bottleneck.
Copper just can't keep up over distance at those speeds.
Right. And this is where they see a significant transition to optical interconnects happening, using light instead of electricity to carry the data between chips or modules.
And is that a big future opportunity for Broadcom? They play in optics too, right?
Oh, yeah. According to them, it's a huge potential market expansion, and they anticipate this shift starting to happen relatively soon, maybe within a year or two.
A year or two, okay.
They mentioned a couple of ways this could happen. Co-packaged optics, CPO, where the optical bits are integrated right onto the same package as the silicon chip.
Right, super close integration.
Or, perhaps more likely in the near term, advanced pluggable optics, modules you can plug into the switches or network cards. Either way, moving from copper to optical for these critical scale-up links represents a significant new market for high-performance optical components, which is right in their wheelhouse.
Makes sense. What about the competitive landscape here? In AI networking, we hear about proprietary systems like NVLink from NVIDIA.
Yeah, they definitely addressed that. Management acknowledged that competing proprietary ecosystems exist. They specifically mention NVIDIA's NVLink and also Intel's developing UA-Link.
Okay.
However, they stated their strong belief, based on decades of networking history, that open standard Ethernet will ultimately prevail, just like it did in enterprise networking and data centers over the last 20 years.
Their argument being that open standards tend to win out over time.
Essentially, yeah.
Yeah.
Their view is you don't need new proprietary standards just for basic data transfer when open protocols like Ethernet, especially with ongoing enhancements, can do the job efficiently and offer customers more choice and flexibility.
Okay, interesting perspective there on the networking standards battle. Let's shift back quickly to the software side. VMware. How's that integration really progressing in terms of getting customers onto the new model?
Well, as we noted, the conversion status among your largest customers is pretty advanced.
Yeah.
That 87% plus figure for the top 10,000 moving to the VCF subscription model is significant progress.
So does that mean the heavy lifting on conversion is almost done?
Not quite. Management was clear on this. They indicated they still have at least another year plus, maybe a year and a half to go, just in converting the remaining major accounts within that core group of large customers.
Okay, so another year, year and a half of runway just with the big guys.
Exactly. It underscores that this is a multi-year process.
Yeah.
It's well underway, clearly yielding results now, but there's still a significant path ahead to fully capture that predictable subscription revenue from the whole base.
Got it. So that software engine still has fuel in the tank from the conversion process itself.
Definitely seems that way. Now, maybe we should touch briefly on some of the other financial details. Beyond just the revenue and profit headlines, things like cash flow, balance sheet management.
Yeah, good idea. Free cash flow looked solid, right?
Yes, very solid. $6.4 billion in free cash flow for Q2. That's about 43% of revenue.
43% FCF margin. Strong.
Very strong. They did note, though, that the FCF percentage is currently a bit lower than it might otherwise be because of increased interest expense, from the debt taken on for VMware, and also higher cash taxes they're paying now.
Right, those are drags on free cash flow conversion. What was cash from operations?
Cash from operations itself was $6.555 billion. Still very healthy.
Okay. What about inventory levels? Are they building up stock?
Inventory stands at $2 billion. That's up about 6% sequentially from Q1 and represents about 69 days of inventory.
69 days. Is that high, low? What's their take?
Management described their approach as disciplined, but they did say they were selectively building some inventory, presumably in anticipation of future revenue growth, especially for certain high-demand products like those AI components.
Makes sense. You need the parts to meet the demand. And days sales, outstanding, DSO. How quickly are customers paying?
That actually improved. It was down to 34 days in Q2, which is better than the 40 days it was a year ago. So, efficient collections.
Good sign. Okay, looking at the balance sheet itself, where do they stand on debt now post-VMware? That was a big chunk of debt they took on.
It was. They ended Q2 with $9.5 billion in cash on hand, and gross principal debt stood at $69.4 billion.
$69.4 billion.
But they've already chipped away at that slightly. They made a debt repayment of $1.6 billion after the quarter closed, so that brings the principal debt number down a bit to $67.8 billion.
Okay, starting to pay it down. How are they thinking about using their cash overall? What's the capital allocation strategy? Dividends, debt, buybacks?
Yeah, they were quite clear and consistent on this. Priority number one is the dividend. They aim to return about half of the prior year's free cash flow to shareholders via dividends.
Okay, dividend first.
After that, the absolute top priority is debt repayment. They explicitly stated their goal is to deleverage to get their gross debt down to a level where the debt-to-EBITDA ratio is closer to 2x.
Right, bringing that leverage down significantly.
Yeah, exactly. And then after dividends and debt paydown, they will consider opportunistic share repurchases if they see value. And they clearly saw value in Q2. They spent $4.2 billion on buybacks.
$4.2 billion on buybacks in one quarter.
Yeah, acquiring approximately 25 million shares. So quite active on that front in Q2.
Okay. And what about future M&A? Are they out shopping again, or is the focus on integration and debt reduction?
The commentary suggests the focus is very much on the latter right now. Management views any potential future M&A as likely requiring significant debt. So actively reducing their current debt burden is seen as the prudent move. It helps preserve or maybe even expand their borrowing capacity for any substantial future deals they might want to consider down the road.
Makes sense. Get the house in order financially before thinking about the next big move.
Precisely.
Okay, finally, let's just touch on a couple of points where maybe management addressed areas of uncertainty or perhaps didn't provide updates people were looking for.
Yeah, a couple of things stood out. One key area was regulatory risk, particularly around export controls on advanced AI products. That's a hot topic.
Right, always a concern in this space. What did they say?
Well, when asked directly about whether they could provide comfort around this risk, Hock Tan's response, according to the transcript, was pretty blunt. He said, "Nobody can give anybody comfort in this environment."
Wow, nobody can give comfort. That really highlights the uncertainty, doesn't it?
It does. It signals that the global trade regulation landscape for AI is still very dynamic and unpredictable, even for major players like Broadcom.
Okay, what else? They also talked about potential future revenue from prospects, right? Customers they hope to win over.
Yes, but they were very careful here. They made it clear that their near-term forecasts and their official guidance rely only on revenue they have high visibility on, meaning from active existing customers.
So, no blue sky in the forecast.
Exactly. They are not including any potential future contributions from those prospects in the guidance numbers. They said they won't provide updates on that until actual revenue conversion is certain. So it indicates a degree of, conservatism in their public forecasts.
Got it. And lastly, that longer-term AI revenue opportunity figure, they've sometimes hinted at much bigger numbers out by, say, 2027. Any update on that?
No, no update was provided on that specific longer-term figure in this call. Their current forecasts, including that interesting commentary about potentially sustaining 60% growth into fiscal 26, still seems based primarily on the customer activity and market dynamics they can see and predict right now.
Okay, so zooming out then, to wrap this deep dive up, Broadcom's Q2 really paints this picture, doesn't it? A company executing very strongly on two major fronts.
Yeah, definitely.
First, riding that massive wave of AI infrastructure build-out. You see it in the accelerating semiconductor growth, fueled by new products like Tomahawk 6, and that increasing demand for inference.
Right. And second, successfully transforming that huge VMware installed base into a growing, sticky subscription software business. The VCF conversion progress is key there.
And looking ahead, they see potential for this rapid AI growth to continue into next year, maybe sustaining that 60% rate, all while managing their finances with a clear focus. Predictable returns to shareholders via dividends, aggressively paying down debt.
And preserving capacity for potential future strategic moves. It's a clear playbook.
Absolutely. So these insights, for you listening, are really crucial for understanding Broadcom's current position. You can see how effectively they seem positioned to capitalize on, really, two of the most significant trends in tech today. That AI infrastructure build-out and the big shift to subscription models in enterprise software.
Yeah, they're right at the confluence of those major trends.
So here's a final thought maybe to leave you with. As the AI world really shifts emphasis, moving beyond just training these cutting-edge models to widely deploying AI for actual monetization through inference, how might that fundamental shift change the whole dynamic of AI chip demand?
Good question.
Not just in terms of raw compute power, but also the critical networking and software infrastructure needed to make it all work efficiently and reliably at massive scale. And layered on top of that, how do the complexities of global trade uncertainty, which Hock Tan alluded to, factor into who is really best positioned to capture that evolving opportunity over the next few years?
That's a lot to chew on. The interplay between inference demand, networking at scale, software integration, and geopolitics. It's going to be fascinating to watch how that unfolds.
Definitely something worth considering as we continue to track this rapidly evolving space.